Right now, the S&P 500 is priced at a CAPE ratio near 42. That number has only shown up twice in the last 30 years, right before the dot-com crash and again just ahead of the 2022 correction. Most advisors will tell you, time in the market beats timing the market. For someone in their 30s, that's true. For someone 60 or 62, the math works differently. A 50% drop at 30 is a buying opportunity. The same drop at 62 is a delayed retirement or a permanent cut to the life you planned. There's a second problem hiding inside that index fund you think is diversified. The 10 largest companies now make up more than 40% of the S&P 500, a concentration level this market hasn't seen in over 2 decades. If you're following the standard buy and hold advice today, you're not really spread across the American economy. You're making a concentrated bet on a handful of technology companies at a valuation level that has historically been followed by a decade of close to zero real returns. I've watched people build 30 years of discipline into a portfolio, only to lose the timing at the exact moment it mattered most. That's not a failure of effort. It's a gap in the plan. So this isn't about predicting the crash, and it isn't about pulling everything into cash and hoping you're right. I'm going to walk you through the specific rule-based trigger that professional money managers use to protect what you've built without giving up the upside, the kind of mechanism that would have protected a $1 million portfolio by more than $300,000 during the last major downturn. If you're within 5 years of retirement on either side, that's the zone this channel is built for. Subscribe because we're tracking the market shifts and the 2026 tax and Social Security changes that actually affect people your age, so you don't end up living through the next lost decade by accident. The concentration inside the S&P 500 has quietly become the highest it's been in more than 30 years. Research from J.P. Morgan's asset management team puts the 10 largest companies at more than 40% of the index by weight, a level that surpasses what we saw at the peak of the dot-com bubble back in 2000. That's worth sitting with for a second, because most people assume an index fund spreads their risk across hundreds of companies, not concentrates it in a handful. This is the part that catches people off guard early. When you buy the S&P 500 today, you're not buying a slice of the American economy the way you were in 1995 or even 2010. You're buying a momentum bet on a small group of technology companies, wrapped in the label of diversification. If one of those companies drops 20% on a single earnings report, your quote-unquote diversified retirement account takes the hit right along with it. There's a shift in identity that happens somewhere around retirement, and almost nobody names it out loud. For 30 years, your job was to grow the pile. Once you retire, the job changes. You're not an investor building a number anymore. You're a distributor, someone managing a stream of income that has to hold up for 20 or 30 years, no matter what the market does in any given year. That distinction changes which risks are worth taking. There's a cost to staying fully invested that almost nobody writes down. It can work out fine in a good year, but if it goes wrong at the exact moment you start pulling money out, you don't just lose paper value. You lock in a hole that your future withdrawals can never fully climb out of. Let's walk through the math on that, because it's simpler than it sounds. Say you retire with a $1 million portfolio, withdrawing 4% a year. If the market drops 30%, your account falls to $700,000, and you're still pulling the same dollar amount out every year. To get back to even, you don't need a 30% gain. you need something closer to 55%. Because every dollar you withdrew while the account was down never gets the chance to recover. This isn't a theory. Robert Shiller's CAPE ratio, which adjusts stock prices for 10 years of earnings and inflation, is sitting near 42. That matters because every time it's reached this level before, in 2000 and again heading into 2022, the years that followed delivered returns well below the long-run average. It's not a prediction of a crash on a specific date. It's a signal that the price you're paying for future growth is unusually high. So if selling everything isn't the answer, and doing nothing feels reckless at these prices, what actually works? The next part is the piece most retirement content skips completely, and it's what separates a rule-based plan from a guess. The system professional money managers use isn't market timing in the way most people picture it. Nobody is trying to call the exact top or the exact bottom. It's called valuation-aware rebalancing. The idea is simple. You let a small number of rules decide when to shift your mix, instead of your gut deciding in the middle of a scary headline. The first rule centers on that CAPE ratio we talked about. When it climbs above 30, you don't sell everything and run to cash. You shift what's called your equity glide path, gradually reducing your stock exposure and increasing what's parked in safer, income-producing assets. Think of it less like an alarm and more like a dimmer switch. The second rule is simpler and more mechanical. It tracks the S&P 500's 200-day moving average, which is just the average closing price over the last 200 trading days. When the index closes below that line, it's historically been a signal that the trend has turned, and it's a cue to move more of your money toward your income floor, the part of your portfolio built to cover your bills no matter what stocks do next. I used to tell almost everyone the same thing. Buy the index, hold it, and don't look at it again for 20 years. Then I watched what happened to people close to retirement in 2008, and again in 2022. Forgetting about your portfolio is a luxury that mostly belongs to someone in their 30s with decades to recover. I was wrong to think one strategy fit every age, and I don't say that lightly. Here's what that trade-off actually looks like in dollars. Say you're holding 70% in stocks, and the CAPE trigger tells you to shift down to 50%, moving the difference into your income floor. If the market then drops 20%, the fully invested version of that portfolio loses about $40,000 more than the version that already shifted. That $40,000 difference is real money. It's close to 2 years of Medicare Part B premiums and everyday living expenses for a lot of retired households. Notice what that trade-off costs on the other side. If the market keeps climbing instead of dropping, the 50% portfolio makes less than the 70% portfolio would have. That's the price of the insurance. You're not trying to win every single year. You're trying to make sure no one bad year takes your retirement off the table. None of this requires predicting anything. The CAPE ratio and the 200-day average are both numbers you can check without a finance degree. And the rule tells you what to do before the emotional decision even shows up. That's the whole point of building it as a system instead of a gut call made in the middle of a market sell-off. The two signals won't always agree with each other, and that's fine. If the CAPE ratio is elevated, but the 200-day average hasn't broken yet, you don't act on the trend signal alone. You wait for confirmation, because reacting to every wiggle in the market is its own kind of mistake. The whole system exists to keep you from making decisions out of fear or headlines, and instead let a couple of numbers you can check in 5 minutes make the call for you. But even a good rule has a blind spot. What happens if the downturn doesn't bounce back in a year or two? Most retirement plans assume a 3-year cushion is enough. History says that assumption has failed before, and it's worth understanding exactly how. Go back to 1973. The market entered a bear market that, once you adjust for inflation, didn't fully recover for close to 8 years. Anyone who retired right at the start of that stretch and was pulling money out the entire time faced a completely different reality than someone who retired a few years earlier or later, even though they may have held the exact same investments. The years right after 1973 are sometimes called a lost decade, and the label fits. Stocks technically bounced around during that stretch, but anyone spending down a portfolio, while prices stayed flat or fell in real terms, watched their nest egg shrink a little more every year, even in years the headlines called a recovery. That's the concept researchers call sequence of returns risk, and it's one of the least understood ideas in retirement planning. It's not just how your investments perform on average over 30 years. It's the specific order those returns show up in, especially in the first few years after you stop working and start withdrawing. Vanguard's own research on retirement income puts it plainly. A downturn that hits right as you begin taking money out does far more damage than the same downturn hitting 10 years into retirement, even if the long-term average return ends up identical. Most retirement plans lean on what's called a 3-year cash cushion, money set aside so you're not forced to sell stocks during a downturn. It sounds reasonable, and for a short, sharp correction, it usually works fine. The problem shows up when the downturn doesn't cooperate with your timeline. Look at 2000 through 2005. That stretch kept stocks depressed for close to 5 years. Anyone leaning on a 3-year cushion ran out of safe money with 2 years still to go, forced to start selling stocks at exactly the point they'd fallen the furthest. That's the quiet trap inside a static cash cushion. It works fine on paper, right up until reality runs longer than your spreadsheet assumed. Once you understand that, a fixed 3-year buffer starts to look less like safety and more like a guess dressed up as a plan. What you actually need is something that adjusts based on what the market is doing, instead of a number picked in advance. That's what a dynamic guardrail does, and it's simpler to build than most people expect. Picture a scenario that isn't far-fetched for where things stand in 2026. Stocks slide 15%, but inflation doesn't cooperate and stays around 4%. Meanwhile, the 2026 Social Security cost of living adjustment came in at 2.8%, which means guaranteed income is rising slower than the bills it's supposed to cover. Here's what that looks like for 2 retirees living through the exact same year. The first one has no rule in place. They watch their account balance shrink every time they check it, while their Medicare Part B premium, now $202.90 a month, and their grocery bill both keep climbing. Eventually the fear wins, and they move everything to cash, but only after most of the damage is already done. Selling at the bottom locks in the loss instead of avoiding it. The second retiree built their guardrail before the correction started. When the CAPE trigger fired, they had already shifted their income floor to cover 5 years of expenses instead of 3, sitting in a mix of short-term treasuries and money market funds that didn't move when stocks did. They're also using the added deduction available to people 65 and older, worth $6,000 per person, to reduce the tax bite on the required withdrawals they have to start taking at age 73. That's not a loophole. It's simply using the rules as they're written to keep more of their own money. There's a detail that makes this worse for anyone already taking required withdrawals from a retirement account. The dollar amount you're forced to pull out each year is based on your account balance from the end of the previous year, not on what the market is doing right now. A retiree required to withdraw a fixed amount from a portfolio that just dropped 15% ends up selling more shares to generate that same dollar figure, which digs the hole even deeper. The difference between those two retirees isn't luck, and it isn't a bigger portfolio. It's whether a plan existed before the correction started, instead of being improvised in the middle of it. Which raises the obvious question: how do you actually set guardrails like this without turning it into a second job, checking financial news every hour of every day? Here's how this works in practice, broken into steps you can walk through with your own numbers. Start with your floor. Add up your guaranteed income, Social Security plus any pension, and that's the amount that arrives no matter what the market does. Next, find your gap. If your household needs $8,000 a month to live the way you want, and your floor covers $5,000 of that, your investment portfolio has to supply the remaining $3,000 every month. Now build your buffer. Multiply that monthly gap by 60 months to cover 5 years, which in this example comes to $180,000. That money sits in a ladder of treasury bills and money market funds, not in stocks, so a downturn in the market never forces you to sell shares at a loss just to pay your bills. Then set your rebalancing rule. If your stock allocation ever climbs above 60% of your total portfolio, whether from market gains or from letting it drift, you sell the excess and use it to refill your 5-year buffer. This isn't something you check daily. Once or twice a year is enough. Consider a couple in their early 60s with a $1,200,000 portfolio, 40% of it sitting in just 3 technology stocks without them fully realizing it. Once they rebuilt that concentration into a properly funded 5-year buffer, their monthly lifestyle stopped depending on what any single company's earnings report said the following quarter. That's the version of this plan that actually holds up when the next valuation extreme shows up in the headlines. There's a specific kind of discomfort that comes with watching your neighbor brag about gains while your money sits in something boring and safe. It's called FOMO, the fear of missing out, and it's one of the hardest feelings to sit with in this whole process. That feeling is completely normal, and it doesn't mean your plan is wrong. It's an old wiring in the brain built for staying close to the group, not for judging whether a technology stock is fairly priced. Feeling left out when the market runs without you isn't a sign you made a mistake. It's an old instinct firing in a situation it was never built to handle. The reframe that helps most people is thinking about those safer dollars differently. Every dollar you move into your income floor isn't a missed opportunity. It's a premium paid on an insurance policy, one designed to make sure you never have to move back in with your kids or go back to work at 70 because the market didn't cooperate on your timeline. Here's the recap. We're sitting at a valuation extreme this market has only touched a couple of times in 30 years. That doesn't mean panic, and it doesn't mean ignoring it either. It means adjusting the course, using a valuation trigger to guide your stock exposure and a 5-year dynamic buffer to make sure a downturn never forces your hand. You worked 30 years to build this. Don't let a single bad decade take a chunk of it away because the plan was never written down. If this kind of thinking is useful to you, subscribe to Wes Investor. We track the market shifts and the policy changes that actually affect people in your exact position, not generic advice built for someone 30 years younger. I don't have a crystal ball, and I'm not going to pretend I know whether the next downturn shows up next year or in 2028. What I do know is that being early to safety costs you a little upside. Being late to the exit costs you the whole plan.